D-mart, that much-awaited IPO, opens on the 8th of March and closes on the 10th of March. The IPO will be within a price band of 295 to 299 per share. What does this mean for the retail major and the sector in its entirety? To shed more light on this, joining us on the show is Pranoy Kurian. He's a senior analyst for Institutional Research at IDBI Capital. Good morning, Pronoy. Always good to have you on the show. Let's start off with the broader contours of the issue. And let's start with valuations basically. So because in the peerage, there's probably only Big Bazaar which finds itself in future retail. Reliance Fresh is not listed. So if you can give a rough comparison of what kind of nearest peers are we looking at, and start with valuations.
So within the segment, direct peers in the grocery, there's Spencer's, there's Trent, in broader retail. And then you also have future retail, then you have fashion-related peer, you have Hypercity. But some of these aren't listed, and among those who are listed, them valuations are a little difficult to ascertain because many of them are loss-making, many of them have very low margins, and the multiples don't really reflect what the market expects. So if we look at, say, if you're looking for the current valuations of the D-mart, it's currently trading at an EV/EBITDA of 17x and 35x on a annualized PE basis. Further, on EV to sales, it's 1.5 times, which is where we feel that's quite an attractive measure. And if you look at on an EV/EBITDA basis, there's Shoppers Stop trades around 17x, the same comparison, and even I think future retail trades around the same level. But I think it's difficult to compare directly. Instead, you value it on its own metrics, and then you try to value it based on what you see the future cash flows will be.
Right. Pranoy, in terms of valuations, a listing which is quite positive is expected from D-mart. So, I know this is a little hypothetical at this point because the issue itself hasn't opened. But assuming a price band upper end that's at 229, what kind of a level incrementally post-listing will make you a little wary about valuations?
No, I think the reaction so far, at least according to what we have heard, is the reaction is very positive. And our own opinion is that the valuations are extremely cheap. You're talking about a company that's growing at 40%, nearly 35% in the 9-month period. It has the ability to grow at 30% plus over the next CAGR over FY17 to 19. And it's also got strong organic growth. It's got an excellent track record. Margin expansion could happen. It's happened this year. And you also could see certain deleveraging and certain other benefits of scale which could translate into even higher growth on the PAT level. So if you look at those factors, the valuations are not at all expensive, at least in our opinion.
Right. The current store number is 118 stores with a total area of around 3.59 million square feet in 45 cities. Pranoy, if you have details about what the probable expansion plans for something like a D-mart are, and because in terms of the operational profit per store, I'm assuming that D-mart is one of the healthier candidates from across the peer category. So in terms of incremental store expansion and same store sales growth, if you could share some of your thesis with us.
So since it's an IPO, the company has not really been too specific on the number of stores exactly, and its future, guide doesn't really give future guidance. But roughly, based on broad expectations, we could say it probably touch 140 stores in the next couple of years by FY19. That would probably be a realistic number. And if you look at, so in terms of the same store sales growth, we think that could be roughly around 15 to 20% over the next 2 years CAGR, partly because they have expanded recently, and as those newer stores mature, you'll see an increasing revenue per square foot from those stores as well. So the prospects for both these two metrics same-store sales growth as well as organic, as well as store expansion, lead us to believe that you could easily cross the 30% CAGR mark over FY17 to 19.
And in terms of margin outlook, what's your estimates there? I mean, if we go 2 or 3 years into FY18, FY19, if you have built-in margin assumptions and estimates for that. And secondly, on the revenue mix, because what differentiates D-mart from probably a Shoppers Stop or a Trent or even a V-mart retail, which is more in states like UP and Bihar, is that the foods component in the revenue mix is almost more than half of their what they offer, with general merchandise and apparels at 27 to 28%. Is this mix likely to remain this way and continue to generate a stable CAGR at the EBITDA level as well?
So you're right that 53% of the sales are foods, which is a lower gross margin business. However, this segment has several advantages. It may be lower gross margin, but it drives footfalls and improves sales of other segments, such as non-general merchandise and FMCG sales. And also, this segment is also less prone to disruption by e-commerce. So there's a more certainty in revenue. It's also the demand patterns are more stable there. So we think that's a good thing. Secondly, although the margins in food and this mix of foods is unlikely to change. It hasn't changed in the past 5 years, not much. So we don't see any material change in the next few years either. Secondly, the gross margins are low in food, around less than 15%. The gross margin of the company around 15%. But the company's overall margin profile is very attractive, around 8.8% EBITDA and 7.7% on the EBIT level. And this is much higher than peers who are often negative to low single digits. And we expect this margin to be roughly stable. We can't see too many margin levers, primarily because this year itself it's improved very sharply. So broadly, 7 to 8% EBIT margins would be a positive going forward.
Right. Pranoy, and lastly, before we let you go, if you can take us through some of the metrics as far as the intention of the proceeds, to use the proceeds is concerned. So there's debt repayment of a little over 1,000 crores, and there's a construction purchase of fit-outs for new stores at 366 crores. So a big portion is debt repayment. So can you tell us as to how the company fits in as far as working capital is concerned? Because understandably, channel checks suggest that they are very prompt in the payment of their payment of their goods from procurers, which is a very small period. So in terms of the DSO and the days payables, as also in terms of working capital and overall debt, if you can give your view there.
So the net working capital requirement is around 3% of sales. And one of the advantages they have is they have a very high inventory turnover, around 14 times of sales. So that is one of their reasons why they're successful. They do pay immediately to get cash discounts, which they do pass on to consumers. So they have very efficient working capital requirements, very modest compared to peers at 3% of sales. Also, with regard to debt, they actually have only a modest net debt ratio of around 0.6 on FY16. And actually, the company, even without the IPO, would have been able to fund its expansion plans via cash flow from operations. However, I think due to the listing, a certain amount of money has to come in. So actually, that's one of the risks where you have excess money coming in of 1,800 crores, which will be used over the next 3 years for debt repayment and store expansion, and which could actually suppress ROEs in the near term because you've got excess cash with not enough outlets to spend it on, not enough avenues to spend it on. So actually that's a difficult problem to have because it's excess cash, and the next 3 years they'll probably raise even more money via equity, I think, to conform with the IPO listing norms. So that will be one thing to look out for.